Great. Well, I'm going to kick things off. There might be a few others who are joining here as we go, but it's 11 o'clock, so we'll jump in. So, uh, good morning. Thank you for joining us today for today's webinar. We have a great turnout of existing investors as well as some new ones today. So, thank you for your continued partnership and trust in investing alongside us over the years. Today, we're going to spend some time going through our next investment opportunity, Solhaven at Grand Chute. If you have any questions as we go through the webinar, feel free to add them to the chat box. Otherwise, feel free to send an email or call Nicholas Ganos or myself afterwards. So today in the webinar, there are three of us from Wangard. Myself, Bert Metz, President of Investments and Acquisitions. I've been at the firm for 15 years and one of the partners. Nicholas Ganos, Director of Investor Relations. He is your main point of contact throughout the investment process. And we're fortunate to have Dave Riedel, Development and Acquisitions Manager. He is responsible for finding our next development sites, including finding Solhaven at Grand Chute that meet our investment criteria. He comes from a history at a national development firm that has scaled across the country with similar type of products as well. So today, as part of the webinar, the agenda will be overview of the prototype and development strategy, market overview and deep dive into Grand Chute, and some financial highlights and investor returns. So jumping in, want to first start high level about the multifamily platform and prototype, which Solhaven at Grand Chute fits within. As a firm, we've been around for 30 years and have been vertically integrated as a foundation since Stu Wangard started the firm. This ensures that there's complete transparency across our company, and we're actively receiving boots on the ground feedback from our team. Our maintenance techs and property managers are really our best brand ambassadors and tenant service reps. They're what help drive the tenant satisfaction, is part of our secret sauce, and provides the real world feedback to really hone in on what made our prototype special as how it is today. That even includes some of the nuances of the optimal bedroom design, closet layout, even electrical outlet placement. That's all standardized and documented as our prototype. Not only does it keep our costs low up front, it keeps it lower throughout the life cycle of the asset. From our vertically integrated operations, we have honed in our proprietary two-story walk-up design. We're now really using this secret sauce to further scale. And from this unique design, we've seen a cost savings about 20% compared to the traditional development method. In many cases, like here in Grand Chute, we're able to deliver a product for under $200,000 a unit. And I think what's interesting about that is in many cases in these markets we go into, a starter home is at $500,000 or above. So we're able to, provide a solution to the housing shortage in many of these communities for a very affordable price. This also results in faster lease up and faster delivery of the building within about 8 to 10 months of the first delivery. Operational efficiency wise, what's unique about the product is it has no elevators and no hallways as well. So not only does this keep the cost low up front, it keeps our ongoing operating costs very, very efficient with an operating expense ratio closer to 35%, which a lot of the industry is closer to 40 to 50% on a building that has more of the corridors. This also has a modular design to it, and so we can really apply our prototype to each site that fits our investment criteria. And because we own the plans, we not only drive down the cost of our hard construction costs, we also drive down the cost of the architectural costs because we're not having a new A&E fee each and every time. Not only is, it's not a new prototype. It's been honed in really over the last couple of decades, and it's a prototype design that many of you guys have invested into in the past, including our projects at the Reef, Tivoli Green, Lockland, Hub City. It's really just now replicating our proven design into new markets like Grand Chute. So we've really flipped the development model on its head, and instead of building a building around a site, we're now finding sites that fit our prototype. As I mentioned, this keeps costs down, but it really also keeps our risk down in our investor, for the investors. We and our team know the exact plans. The general contractors know the exact plans. Our subs know how many 2x4s, number of nails, footage of PVC, each and every building they create. And so it's really simplifying the design and construction process and cutting out the fat. In a way, if you're familiar with kind of manufacturing concepts, it's really taken out a page of Six Sigma and applying that to multifamily development. And as a result, we're able to deliver a brand new Class A product for well below what many competitors can deliver at, and affordable rents in markets as well to really kind of create a competitive moat. With all that, our next project that we're talking about of this prototype is Solhaven at Grand Chute. And for some of our investors, as I mentioned, it's a similar product, but going forward, this will be the brand of our prototype, Solhaven. So we're not only standardizing the design, we're standardizing the marketing, the branding, the lease-up process, and so it really makes an extremely efficient process. It establishes a higher-end brand as well, no different than like a Hilton or a Marriott if you're traveling. And so our tenants can really understand if they're going to live in a Solhaven property, the high-end experience, what the layout is, and the customer satisfaction that goes along with it. So with that kind of understanding the platform that we're scaling, I'd like to turn over the show to Dave Riedel to really dive into the specific project, Solhaven at Grand Chute.
Thank you, Burton. Yep, so I'll dive in some of the site specifics. First, to start off, the site is about 13 acres on which we are able to fit 8 of our prototype buildings that Burton was discussing, so that's a total of 208 units. Also on the site is a full clubhouse, which we are also working toward a prototype. This would be the first iteration of that, along with the detached garage bay and maintenance garage. All of these things really defining what we're working toward is a bit of a development unit where the 26-unit building would be paired with garages, with landscaping, with lighting, sidewalks, and things of the like that really put together, make things a lot easier on the civil and the architects as things are designed. The site was originally sourced in June of 2024, which captured a number of different entitlements that we needed. So that includes things like a comp plan amendment, a rezone. This was a newly formed TID, tax increment district, that we had to kind of wait on until the town got that approved with the Joint Revenue Board. And following that, we also went and got a development agreement approval for $1.5 million in tax increment funds from the town. There were a number of offsite easements and cost share agreements that we were able to arrange and secure, teeing it up for this August 2025 groundbreaking. So from there, we are looking to turn over the first building 10 months later, concurrently with the clubhouse. In Plymouth, we did a similar deal that turned over the buildings in 8 months. That was without a clubhouse. So this would really allow us to hit and lease as our buildings are coming online in the prime leasing season in May. So that was always the goal. And as far as amenities are concerned, the competition in Appleton has not yet delivered many clubhouse amenities that we will be offering here. And with our cost basis, we're able to provide that amenity, including the pool, the patio, fire pit, a fitness center, that really allows us to provide those amenities without adding the additional incremental cost given our cost basis, so we can still deliver a higher amenity base for a comparable rent price. And as the Appleton market is concerned as a whole, it has all of the hallmarks of strong fundamentals in the multifamily space, that being higher rent growth, generally at or above 4.5% for each of the last 5 years, strong employment growth, second only to Madison, strong population growth, also second only to Madison, and a healthy employment base. So that base being whether it's Green Bay, Neenah, Oshkosh, or Fond du Lac, then all within 30 to 45 minutes, that totals around 470,000 jobs within a reasonable drive time. The wages in Appleton are also considerably higher, but we can get into that in a minute. But the site specific, the location also has all the general criteria that we at Wangard are seeking to find, that being visibility, traffic counts, hard corner, accessibility, proximity to retail, proximity to grocery stores. You can see the Costco, you can see you can jump onto 41 rather quickly to get to wherever you need to be as far as employment's concerned. It really checks all the boxes as location and amenities are concerned. And then lastly, I'll speak briefly about some of the market metrics that we look at. When we first started sourcing for opportunities, we took kind of a wider look around Wisconsin for market characteristics and strength. At Appleton consistently rose at the top as far as target markets that we need to, source new opportunities in. So see here, stabilized vacancy actually. So this trend shows you overall vacancy that includes properties that are still in lease up. The stabilized vacancy rate in Appleton right now, as of the second quarter 2025, is 2.3%, which is among national leaders and a leader in Wisconsin, lowest in the state. You see construction starts are also declining, providing further headwind or tailwind as we go forward. Something else that's interesting about Appleton's MSA is it boasts the highest median income of any metro area in Wisconsin. So naturally, you would think that that's probably Madison or Milwaukee, but in fact, it is Appleton. And as rents are concerned, the metro median rent is probably middle of the road as Wisconsin metro areas are concerned. So what that means is there's good tailwind on affordability for those renters can afford a higher degree of rent given the income that they earn. This is kind of another way to exemplify that same point is that while they can afford more, the housing stock since COVID, you'll see in 2021 is considerably higher. So that makes the attainability for ownership a little bit more difficult and increases the likelihood for continued rentership. Another tailwind for Appleton. And then lastly, you can see here at the lower part of the chart is that rent growth since 2021 has consistently remained at or around 5%. Housing affordability really went up rather significantly during COVID. And with the state's low vacancy, the state's high or the statewide low vacancies and statewide high incomes, steady rent growth, and strong forward fundamentals with a limited forward pipeline, we see when this project turns over in 32 months at full completion that the fundamentals will remain strong and that the tailwinds are there. So with that, I will turn it back to Burton.
Thank you, Dave. Appreciate diving into the market and highlighting what excites us and excites you about the site and the fundamentals. So next, I'd like to turn it over to Nicholas Ganos to really dive into the investor returns and profile of the deal.
Thank you, Burton. And thank you again, everybody, for joining us today. In the first part of the webinar, you heard from Burton about our prototype multifamily platform and the advantages it provides. You then just heard from Dave about Appleton and the market as a whole and some of the general trends we are seeing. I will now dig into project specifics. So the Solhaven at Grand Chute development will feature 8 of our prototype buildings, totaling 208 units. As Dave previously stated, some of our amenities that we are going to include are a pool, clubhouse, fitness center, even EV charging stations, amenities that are not typically standard in the Appleton market. The Appleton area also has good combination of low unemployment and low vacancy. And with a 25-minute drive, and within a 25-minute drive of the property, there are approximately 200,000 jobs, 60% of which are white collar. So Solhaven will have a unit mix that will range from studios to 3-bedroom apartments. And we believe Solhaven is arguably better than the competitors in the area for a variety of reasons. Some of the comps use black appliances. We're going to provide stainless. Some have no attached garages or little to no amenities at all. Some have extraordinary pet rents, or do not allow pets at all. And critically, only one other comp in the area provides the full range of unit types like Solhaven will, the studio to 3-bedroom units. By providing this full range of units, we can offer the best options for all people, singles, couples, even young families, and not only now, but as their living situation changes into the future. To dig specifically into the project, the cost is estimated to be $39.8 million, or about $191,000 a unit. The equity raise will be approximately $12.8 million, and our hold period is for 3 years, which aligns with both the construction loan and also what investors are looking for when they want development type returns. And you can see the exit cap rate of 5.75%. During our research in the market and due diligence, we spoke with several brokers in the market and used their guidance and feedback to come to this number. As we look at specific returns for both Class A and Class B investors, you can see that Class A investors are looking at a 16.72% return and a 1.59 multiple, equity multiple. And Class B investors are looking at a 15.64% return with a 1.55 equity multiple. Now, you may ask what the difference is between Class A and Class B shares. Well, Class A shares are for those who invest $2 million or more. Class B are for those that invest less than $2 million. And the second difference is in the waterfall structure, which is how investors and sponsors share in the proceeds upon sale. But you will also see that there is no preferential treatment between Class A and Class B investors within the capital stack. Both are treated equally regarding their position and their pro rata percentages in the investment. Some people have already invested into real estate, and some are looking at this for their first opportunity. So there are some advantages to investing in real estate. Some advantages like diversification from stocks and bonds. There's no direct correlation in movement of the stock market versus real estate. And for those looking at capital preservation, real estate can help where the markets are negative, especially as we've seen over these last couple of months with the stock market going up and down tremendously sometimes. Another advantage of real estate is some potential tax benefits, like depreciation, which can help offset passive income. When looking to invest with a sponsor like Wangard, we can provide access to off-market deals. And led by Burton Metz, our president of acquisitions, we have deep relationships with brokers, allowing us the ability to find deals that are not offered in the market, and thereby potentially leading to better pricing and a lower cost basis. And then there's also transparency and reporting. If you are going to invest with a sponsor, you want to look for these. We are open and upfront. We provide monthly updates during the construction process and quarterly updates afterwards for all the projects that you are invested in. And we also utilize an investor portal, providing investor access to all reports, documents, including tax documents, and also providing some information on upcoming offerings. It is important to note that you should contact your financial advisor on how an investment into real estate can fit into your portfolio. Moving away from Solhaven and what Wangard has coming up in the future, our pipeline is currently has more than 800 units in the development stages all across the state of Wisconsin, from the suburbs of Milwaukee to Madison to Wausau and Kenosha. As Dave spoke about in his buy versus rent chart, the cost of home ownership has increased significantly faster than the cost to rent. And these projects are in response to market demands for quality housing in these areas. As Burton leads up the acquisitions team, We are pleased to say that we have closed on 2 industrial acquisitions so far this year and are constantly looking for other projects to acquire. So if you are an investor looking for cash flow, capital appreciation, or have a, let's say, 1031 exchange, or needing to invest in an opportunity zone, we have the ability to provide these options for you. And of course, an investment into real estate won't be as successful if you sell at the wrong time. So our asset management team researches market trends to find the optimal time to exit out of an investment. This allows the investor to reallocate their funds into new projects, thereby maximizing overall investor returns. We are also looking to roll out a multifamily fund. Previously, like SOLHAVEN at Grand Chute, that is a direct investment into an opportunity. Well, later on this year, we will be rolling out our SOLHAVEN Multifamily Fund, designed to spread equity across multiple development opportunities. Our target raise will be $30 million, and our target return will be 18 to 20% on a 5 to 7 year hold. Please be on the lookout later this year for more information. If you have an interest in SOLHAVEN at Grand Chute, or want to hear more about the multifamily fund, please do not hesitate to reach out. And with that, I will turn it back over to Burton.
Thank you, Nicholas, for diving into the investor returns. A couple questions popped up through the webinar. One of them is answered, but for the benefit of everybody, I'll ask Dave the question. Is related to TID. How does that help us, and is it going to impact the hold period? So if you want to kind of talk a little bit about that, Dave.
Right. So the answer is posted here in the webinar chat, but the question is, does the TID impact the investors at the hold period? And the quick answer is no, it does not impact the hold period. So the $1.5 million incentive that we negotiated with the town is owed to the developer. That's something that's edified in the development agreement and will run with the land on sale. So the 1.5 is reimbursed back to us once the property is fully assessed via 85% of our annual tax bill. So however long it takes for that 85% reimbursement to come back to us, for however long it takes to equal 1.5 million, that's how long the length of the TID is. And if there's outstanding balance on that, when we decide to sell to a third party, what's traditionally calculated is that's treated as forward cash flow, and then a net present value of those future cash flows are calculated and then added to the sale price.
Thank you, Dave. One additional question, I can answer this one, is how does the new big beautiful bill affect this investment and our philosophy going forward? Nicholas, feel free to jump in on this one as well, but I mean, high level, it should be a very positive thing for real estate investment in general. It's gone back to 100% bonus depreciation. We're still diving into the details as to when that effect will be. But by the time this is delivered, the 100% bonus depreciation should be in effect, which just further improves some of the tax benefits that goes along to our investors on a pro rata basis based on their investment. Another interesting part, doesn't necessarily affect on multifamily, but it does on industrial, is there's kind of a new tax item of 100% expensing of a manufacturing facility. So from our industrial side, we believe there's going to be a lot more investment into manufacturing facilities. That's part of the reason why we were bullish even prior to that of acquiring some industrial assets. And in markets like Grand Chute, Fox Valley area, there is a heavy amount of manufacturing type businesses. And so the more jobs, the more investment into those manufacturing plants should further improve even the multifamily side of things with more population growth and income growth. So with that, thank you for joining us today for the webinar. And we're excited about the market. We're excited about this deal. It's a very strong market, as kind of mentioned by Dave, very low basis at 192 a unit that we feel is going to put us in a very strong position for not only quick lease up, but kind of attractive rent growth and exit for the investors. So we're about 50% raised. As Nicholas mentioned, we're looking to kind of close in early August. So if any interest, feel free to reach out to Nicholas or myself, and we'll go from there. So appreciate everybody's time today.
Thank you.